Have you ever wondered why the market looks like it's going to break out in a certain direction, only to fake you out and then make a big move in the completely opposite direction? Have you ever wondered why the market looks like it's going to break out, only to fake you out and then make a move in the opposite direction? That's not random. That's not random. It's a trap. The market is designed to trick you into taking bad positions and take your money. But if you know how to spot these setups, you can profit from them instead. Today, we're going to review Patrick's 5 rules for price action. So let's see how we can use these price action rules for more profitable, higher probability trades.
Today, we're going to talk about 5 different concepts to help you master price action. If you want to be a successful day trader, you need to understand these 5 concepts when it comes to overall price action. Knowing when to stay long bias and knowing when to start looking for shorts. This is going to save you a lot of time and a lot of effort. Let's get right into it. All right,
so we got the whole thing mapped out. We're going to start with the 15-minute candle rule. Then we'll do trend lines, then the 1-hour chart, then pivot points, then spotting traps and liquidity runs, and then of course your trades by Bren take action challenge, because you know my commitment with this video is to make his video 10 times more valuable for you, so you're 10 times more likely to apply to your own trading and get some of this. Let's go.
So we're going to be talking about 5 different concepts. These are all very important concepts, so make sure you watch the entire video. Not one concept is more important than the other. They all kind of build on each other. So for the first concept, let's talk about a very simple idea with my favorite time frame when it comes to understanding price action, and that is the 15-minute chart. Looking at the 15-minute chart, we have this big old 15-minute candle, right? What we want to understand is that basically the middle of this candle is like a 50% pullback, right? If you're thinking about Fibonacci's, a lot of people will trade 50% pullbacks. Well, the middle of this candle, that 15-minute candle, is going to be the 50% kind of pullback area. What happens if we stay above this level? If we stay above this level in this area, what are you thinking? We're thinking that it's bullish, right?
All right, so we're going to mark that 50%. So the midpoint of the candle serves as key support and resistance. Another way to say it, support and resistance. And the rule is this: if the price is above 50%, bullish trend. If the price is below 50%, bearish. Okay. And I'm just going to change this to say bearish. Okay. I'm not going to say a trend because it may or may not be a trend. It might just be bullishness. Okay.
The bullish price action, there's no reason to get short here until we get candles to close below this level. And even then, we're still not looking for a short until we really have this kind of lower high formed below that level. So this is going to save you a lot of heartache and a lot of time if you're just able to identify one simple idea. The 15-minute chart, where is the middle of that candle? Right there in the middle. Okay. As long as the price action stays above that 50% area on that 15-minute candle, well, price action is bullish, and we're looking for price action to move up here, which it ended up doing. So on this setup right here, we're basically looking for a breakout. We go to the smaller time frames. This is the 9 o'clock candle, the 9:15 candle, and then the 9:30 candle.
And what you have right here is a bull flag. What is a flag? A flag is a pause. You know, like in a car race where they tell you to like slow down and pause at the end of the race? That's like this, okay? So you draw this line, and as soon as this line gets broken, that means we have an indicator of bull trend continuation. So we're combining 2 different things here. One, we're making this line at 50% of this candle. Pretty easy, right? And then we're drawing a line connecting these lower highs and waiting for a break of that line to double confirm our move up. Okay, so we're taking 2 different reasons to enter a trade, because you don't want to enter a trade with only one reason. You need at least 2.
There. Same idea. As the market starts moving higher, we can keep looking to see where these candles are closing based on the previous candle. So as you can see, you could do the same thing here, right? You could mark the 50% down here,
draw a line, wait for it to get broken, and you could see that setup worked again, okay? So here's our 15-minute candle rule. You've got it. Candle closes are used to confirm or deny the trend.
You see right here, this candle closes right there, right? This is the open, the close, that 15-minute candle. You had a wick on top. This candle closed at the low of the previous candle, right? So it basically got through the 50% point and closed down there. So that's going to be telling me that there's going to be more of a pullback coming. And where is my next kind of level? Well, I always love to kind of look for those areas of resistance turning into support, which it ended up doing. We pulled back here into the 40s before moving higher. Very simple idea. 15-minute chart. If we can't hold the low of the previous 15-minute candle, well, it's telling me that there's a pretty good chance that we're going to retest a previous area of resistance or support and vice versa. So we broke through the low right there. We moved down to this previous area of resistance. That was our previous area of a breakout level, right? We broke out through that level. We pulled back. We're pretty much like in this range. So we talked about this as well on Friday, the idea of getting back through that 20 level and then looking for that move up. And guess what happened? Look at that move up. The move up was beautiful all the way up there to the 228. So a beautiful move up. And that was simply identifying a very easy level to focus on here until we got back above this kind of area that we sold through, until we got through that 20 area again. We're not looking for longs until we get through there. Now, you could be long down here off this level, off the 40s. Sure, you take that if you're looking for that. But overall, we don't really need to be buying breakouts. We don't need to be buying a move up until we get through this previous area of resistance right there, pretty much, again, at that 50% point on this 15-minute candle. The range of that 15-minute candle right there, 90 to the 152, 160 area, right? So we pretty much know that the 50% point on that candle is right around there, and that's where we need to get through. So once we got through there, now we have opportunity to start looking for long. So you really need to be looking at that 50% point on the 15-minute candle. If we can't hold the 50% area, well, then there's a good chance we're going to pull back, maybe put in a lower high, things like that. So we're looking to see where we're closing at based on that 15-minute candle. This is going to save you a lot of heartache and a lot of time. The second concept.
All right, so we got concept number one. Check the box on that. You've got the 15-minute rule. Now let's get to rule number two, trend lines and market waves. And we're going to start by understanding that the market moves in waves.
And this is going to save you from buying the top, right? What you're looking for is trend lines. We have the Lux Algo indicator on there, but we're looking for trend lines in general. Like, we're just looking for trend lines. The market loves to kind of bounce off trend lines following, you know, the idea the market moves in waves. We're looking for channels. We're looking for all types of different reasons for the market either pull back, go higher, and obey these trend lines. So what we see here is, let's get rid of the indicator for now, just so we can see the clearer price action. Now, obviously, we don't know, like, you know, when the price is up here, we don't know where it's going to pull back of kind of trend. But we can identify that we had this trend line here on the 3-minute chart. So once the price action gets too far off of this trend line from earlier, we're thinking that, hey, this might be a top. This might start to get overextended. There needs to be a pullback. We need to pull back and touch a previous area of support, resistance, trend line, things like that. So once the market starts moving too much off of a trend line, we can think that there's no reason to get long for a breakout until we retest a trend line and then form the next area of structure or support, which you can see we got this big move up off of this trend line at the open, and guess what? We pulled back. What's interesting is you can see, you know, we definitely pulled back into this trend line from earlier in the morning, 9:15, the breakout, it moves up, and guess what? We pulled back. We just couldn't hold there, and we started to then move down. So again, what we're looking for here is trend lines. We're just drawing our trend lines here to see what the price action is doing, give us an idea. So here, basically have another trend line. We have a trend line, we're tapping. So I actually took this short here below the 100. it pushed back up into this trend line. It got down here and then started to squeeze higher. So at this point,
same setup we pointed out before, right? We've got a bull trend, and then we're starting to move down on a pullback. So we're going to connect a line with those lower highs, which marks a bull flag. And then when we get a break of that flag, we have a possibility of trend continuation, which means you could get long possibly after this bull close right here. And you can see, yes, we pulled back for 2 candles after that, but then we continue to move up.
This trend is invalidated. We're putting in this low here. We're holding this breakout area from earlier. And guess what? What do we do now? We just change our trend line once again. Now we have this kind of higher low, higher low, higher low. We're looking to get through that 120 level here. Once we get through the 120s, we can see that trend. We're pushing. And now we're long the breakout here in the move up. I really think you should be looking for multiple taps on a trend line and understanding that, hey, if the market's following this trend line higher, there's no reason to short. There's no reason to short anywhere in here.
Why? Because momentum. So markets have memory, which means they tend to do what they're doing. Another way of saying that is inertia. You know, if you take a ball and you roll it down the street, it's going to keep rolling for a while. The markets have the same kind of energy, inertia. So our rules for how we apply number 2 are to understand that multiple touches on a trend line signify a strong trend. If it touches that trend multiple times, you can see that the market is respecting that trend line. And if it's a bull trend line, you can see that bulls are buying when we get to that trend line. If the market is overextended from a trend line, then a pullback is expected. And then shorts are invalidated when we start to form higher lows. Now, why is that? Because the definition of a bear trend, or something you would want to short, is lower highs and lower lows. So when you see your first lower high, that means we have the possibility of moving down.
At this point, you know, I shorted the break below 100. We moved down. We then started pushing back up. We're putting in these higher lows.
And the opposite is true for a bull trend, right? When we see higher lows, that means that invalidates the bear trend, because the bulls are then taking control. And what that's telling you, the price action is telling you what buyers and sellers are thinking. And that's simply telling you that the buyers are thinking they're more confident than the sellers.
And at that point, the short is invalidated and the market wants to move higher, right? It's just that simple. The market wants to move higher once we basically start putting in that new kind of trend and starting to push back up. Remember, we need to be looking at that 15-minute chart and then look at the smaller time frames. So before you enter a trade, draw your trend line on wherever the most recent trend is.
All right, cool.
Draw your trend line there.
Let's actually try this, okay? Because it's one thing to understand it. It's another thing to actually try it. So let's actually try it. Now, today, we're just going to go in to the 5-minute chart, or you know what? Let's go to the 15-minute chart, and let's actually try the NASDAQ, okay? So look at the NASDAQ futures, and we'll look here, and we'll say, okay, pulling up the 15-minute chart, let's actually just apply what we're learning. So we're looking for trends, and we're looking for, first, remember, our rule number 1 was 15-minute 50%, right? 15-minute candle, 50%. So let's just go to the open of the day, because I like to kind of base myself somewhere. So here's the open of the day. And the first big 15-minute candle was right here, okay? So 15%, or rather 50% of that 15-minute candle would be right here, okay? So let's draw a line right there and mark out 50%, okay? So now we have that marked out. We can delete this because we know our 50% is right there. So we broke through here, and we're going to expect the price to come back and test this line, and we're going to see what happens when it does. Okay, so if we draw a line here, the price is clearly moving down because we have consecutive bear bars, and it comes back to test that line, and there were sellers right there. Do you see how if we zoom in, the price barely got to that point and there were sellers right there? That shows you that the market is respecting a 50% pullback of this bear trend, okay? So if we were to sell there, that would be a reasonable thing, but you don't just want to guess, you want confirmation, which means that once we get this bear bar closing on its low, then that's a reasonable sell. However, we don't just want to use the 15-minute chart, we want to zoom in down. So we're using our top-down analysis, okay? Now this is where things get interesting because we just went from the 15-minute to the 5-minute, and if we really want to get fancy, we can go to the 1-minute. So now let's find the 1-minute on that exact line, okay? So here's the line. We started with the 15-minute. The price pulled back to that area, okay? And then we got a bear bar closing on its low. Now there's your short entry. And if all you did was set your stop loss right at the high of that entry candle, you went for, let's say, 2 times your risk, okay? So that means for every $10, you're going to trade and potentially get $20, right? Then you would put your profit target there, and notice the profit target got hit almost immediately. So if we entered short here, look, the price went straight down. All you would have taken was maybe a couple, like 2 points of drawdown? You would have taken 4 points of drawdown, and then the market would have went directly to your profit target, showing you that not only does this strategy work, but that buyers and sellers are thinking in this exact way.
Your trend line there. Start to draw your trend line. Your trend line right there, another trend line opportunity. You're basically looking for, decent price action to touch the trend line and then follow it higher. And you can see here, we started to get a little bit too overextended. We pushed up, and guess what? We started to pull back. Now, obviously, this is all in hindsight right now, but in general, what we're looking for is multiple areas. These trend lines to be bouncing. There's your next trend line. You're just drawing lines and looking for those pullback areas and then the breakouts. I like to find that area of structure, kind of put my 2 trend lines together, look for a breakout. See here, we broke out. We started to push all the way up there above the 200. So the more kind of structure holds, the better the move higher is going to be, or lower based on the overall move. The third concept that
all right, so we got rule number 1, rule number 2. Let's go to rule number 3, the 1-hour chart for targets, starting with historical support and resistance levels.
I want you to focus on here is the 1-hour chart to find where your targets are. Where is the next area of resistance?
And this time we'll do it right as we go along here, okay? So I'm going to switch right now from the 1-minute chart to the 1-hour chart, okay? So now we're looking at the 1-hour chart, and we're just going to look at today only. All right, let's keep going.
Or support based on being short or long in the markets. Let's talk about. All right, I love the 1-hour chart to find where my targets are going to be. Daily chart, 1-hour chart gives you a really good idea of where support, where resistance is, where you should be looking to take profit based on the move that you're seeing. So right now we're looking at the 1-hour chart here, and all I'm looking for here, okay, we got some resistance here at the 133s. Let's pull that across. Now, obviously, the price, earlier in the day, we wouldn't know that the price is going to be there. But we know that looking back here on the hourly chart, that there is resistance at these levels. So we're going to draw this. This is back from Thursday, October 19th. And then we're going to draw this across there. Again, we know there's resistance from back there in, this is Wednesday, the 18th. So we see that there's resistance there at the 133s. We see that there's resistance there at the 225s. There's some more resistance there at the 175s. So pretty much like these 2-3 levels here, there's resistance based on the hourly chart back there in October. Now we're in November. So you can see, this previous area of resistance. How does it react to the price action today or on Friday? How did the price action react to these levels? So now we look at Friday. And would you look at...
Okay, now how did he find those? He's just looking for prior highs, right? Prior highs. Every time the market made a prior high, he's like, okay, let's have a look there and see what's going on. So if we look at the chart here, and let's just take off all of these indicators so that it's just nice and clean, okay? We'll take off even our executions as well, okay? So there's nothing to distract us. So let's say we're at today, okay? So here's today, all right? And we're going back to see where there was prior resistance, right? where there was prior support and resistance. And so in the case of what we're doing right now, since we're moving down, we're actually looking for prior lows, okay? So we can see very clearly, actually, that there was one here, okay? And then there was one here, and there was one here, okay? Now this one is like this one. And he didn't show you this. He just showed you how to do this with lines. But I like to do this with zones, okay? Because it's necessarily about support and resistance lines. You'll see there's a lot of lines in a certain area that gives you a zone, which I like because it makes it more flexible. You see how this low lined up with this low, okay? So then I could kind of make an area in here. And then also it lined up with this low, but that low's a little bit lower, okay? So what I'll do is I'll just mark those out like that. And that way it'll kind of cover all of them. So I don't have to have like 10 different lines on my chart. So I know that that's a support and resistance area because we had this one, and then that one, okay? That's a little bit hard to see, but I want you to look on your own chart and see what you can see on your chart so that you can follow along. Now, where else do you see some support? Here's another support zone right here, okay? And again, it's very similar. You can see I'm drawing the line where I'm seeing those prior lows, right? So it's right here or right here because we've got lows here and we've got lows there, okay? So we're just kind of eyeballing it and we're looking for best fit. You don't want to overthink this. You just want to look at what's the most obvious. So that's the question to ask yourself. What's most obvious, okay? So put the line here, okay? And then I see another one right here, right? See another one right here. Okay, and if these were the areas, let's pull this back slightly so that we can see how predictive these support zones were. Look, the support zone was here, right? Look what happened here. We went a little bit below it and then we got to move up. So you can see that it's pretty predictive. Now let's look at this one. We came down into this area, went a little below it, actually went to the area below it, okay? So this one didn't really work out for us, but it gave us an approximation of where it was going to start to slow down. And then we moved into this one, this support area, right? And then look, to the tick almost, we bounced out of it, okay? So that's why these hourly candles with these either support or resistance levels give you a really good way to identify profit targets, because if you're holding short, let's say you got short up here and then you exited here or here before you got that move against you, you're a happy, happy boy.
Look at that. We look at this first move of the day. We pushed up, we got denied, we pulled back. This previous area of resistance from the hourly chart that we identified before the market moved. Look what happens. It now turns into support there off of that resistance. It then pushed up to the 189 resistance from previous price action back there in October. It's not rocket science, my friends. If you're looking for a target, you're looking for where the market's going to go, all you need to do is just go to the left, go to the left, go to the left, go to the left. Well, on the hourly chart, it's easier, but just go to the left here. I can't even do it on this chart. There you go. We're back there in October 18th, right? We see the resistance there. And then we pull it over here and we can see, guess what? Once again, where do we go to? The high there, pulled back all the way up there to the 25s. That push up was based on the hourly resistance that we saw back there in the middle of October. It's not rocket science, right? It's really just not rocket science. It's very simple to understand. If the market's going to push up to a level, it's going to push up to previous resistance. Test that. If it's going to go stronger, going to go higher, well, then it's going to break through. But if it's not going to break through, there's a pretty good chance it's going to pull back. That's a good area to take profit at. Nothing wrong with looking at the bigger time frames, the daily chart, the hourly chart, to find out where those major areas of resistance are.
An easy way to remember this is simply by this phrase: markets have memory. Markets have memory. So that's a good way to remember this, because often the price will come back to those areas where there was selling before and find sellers again, or those areas where there was buyers before and find buying again. And that's how you get support and resistance. So just write that down. Markets have memory.
The reason the market got stuck at those levels before, and it's probably going to happen again. It's going to tap that level. It's going to get stuck. It's going to push through. It's going to pull back, whatever it is. You want to know where those areas of resistance are based on the hourly chart and looking back. Look back, 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 and you'll find exactly kind of where you should take profit at. The fourth concept.
All right, let's go to rule number 4. We've got 1, 2, 3. Now we'll get to 4 pivot points for direction.
It's very simple here. I love these pivot points. Pivot points, pivot points, pivot points. Let's talk about them. All right, pulling up the chart here with the pivot points. This is the 5-minute chart. You can basically use the 5-minute, you can use the 3-minute, you can use the 1-minute. Pretty much everything up to the 15-minute chart, you can use it there on the pivot points to see where those pivot points are based on the NASDAQ. So one thing that I would give you a concept here, if I'm going to give you a concept, an idea of how to trade very simply with the pivot points is simple. All right, think about it like this. If we pull back to a pivot point, we turn it into support, well, then we're bullish. If we pull back and we get through that pivot point and we can't stay above it, well, then we're bearish. So on this setup here, this is
so that's the rule for pivot points. When the price is above the pivot point, it indicates bullishness. When the price is below it, it indicates bearishness.
Some from Friday again. So we already know this kind of 120 level. But what we're looking at here is we got the VWAP down there. I like the VWAP on this chart. The VWAP, the pivot points, they kind of love to play with each other. And you can see this big pullback. We pull back to the VWAP. And then we're kind of bouncing around here at the pivot point. So we look at the smaller time frame, the 3-minute chart. I talked about this on Friday. If we start to close below the pivot point, we can't get above it, we start to turn into a downtrend, well then it's bearish, the market's going to move down. But what I want you to focus on here is we start trending higher, right? We start trending higher. So at this point, we're like, hey, if we start closing above the pivot point here, there's a very good chance that guess what? We turn into a kind of bullish trend, start to push higher. The pivot point acts as support, and guess what? We move up to that next pivot point, which is also that previous area of resistance area. That 180, it was 187 there. The pivot points there at the 182s. So we can see that there's resistance there, but we know that if we can push out of this, there's a very good chance that we test that pivot point up there at the 182s. And you can see that pivot point now turns into support and kind of chops around there. But in general, these pivot points love to get touched. They love to act as support. The pivot point from earlier in the day acted as support. We got above it. And look at it. That pivot point now turning into support. So very simple idea. If we're closing above with bullish price action above the pivot point, if we're closing above that, well, then there's a good chance that we then turn it into support and we move higher. If we get denied, we start to pull back and we're in the middle of these pivot points, there's a good chance that we kind of pull back into that pivot point. So you can see here how we kind of pull back into it. We turn it into support. We kind of start to move down a little bit. We then push back up. So pivot points, pivot points, pivot points. I cannot stress enough, my friends. Put the pivot points on your chart and love them. Believe in them. They work. They're real. You know, it's not always simple, but it's pretty simple. If you look at the pivot points, understand the pivot points, the price action based on the pivot points, what is going on? Right? We're holding the pivot points. It's bullish. If we can't hold the pivot points, we're closing below the pivot points. It's bearish. We're looking for opportunities based on where these pivot points are and what the price action is doing based on these pivot points. The fifth concept.
So he says they're not always simple, but they're simple. I don't know what that means. You say one thing and then you say the opposite of the thing. That doesn't make any sense. Here's what I'll say about that. These are indicators. A pivot point is an indicator. An indicator is trying to assess the price action. If you don't understand what's happening with the price action, then you're screwed because sometimes the indicators will be wrong. So what you have to do is take what the indicator says and combine it with your understanding of price action. That's how you actually win in trading. You can't just be a slave to your indicators. Now let's get to rule number 5, spotting traps and liquidity runs.
Concept and the final holy grail of concepts here is price action. You got to put in the time. You got to put in the effort. But I got one more little secret. One little secret for you, my friends. Let's talk about it. All right. I think this is a very easy lesson for you to understand. You need to ask yourself when you're entering a trade, based on where we are with the price action, the market, the move, you need to ask yourself, is there a reason for shorts to get squeezed? Is there a reason for the bulls to dump, get stopped out, whatever it is? Like, you need to be looking for what we call a trap. Where's the trap at? What is the trap? So the trap is basically something to convince either the bulls or the bears to create liquidity, get a move down quickly, and then right back up. So like, this is a great example. We had the open on Friday, had this big squeeze up. We push up to the 78s. Guess what? We start pulling back. We're like chopping. And then for some reason, look at this. We like kind of hold here for a second and we dip right below there. We dip right below guess what happens? We had the low of this candle right there, 41. We had the low right there at 40. So we know that there's this kind of support here. And look at that kind of trap. It dips right down there to the 40s. People are starting to short, right? They're shorting this breakdown here, but what they don't think about is, guess what? We've got all that resistance or support. Well, that's support right there, right? 40s. Support's there. This is the trap. We're trapping shorts. We're stopping out the bulls. We're getting a big move, kind of like quick down and then right back up. And guess what? Look at this break to the upside. Look what happens after the trap has been set. The trap has now closed. It's
Leandro, thank you.
Trapped everybody. It's trapped the shorts there. It's trapped the bears who got stopped out on that move down.
Again, remember that same exact setup I pointed out to you in the beginning of this video. This is called a bull flag, okay? So we're essentially drawing a bear trend line, waiting for that trend line to get invalidated because we have context of a bull trend previously. So we're trying to assess whether or not that trend is going to continue. And then once that trend line is broken, as you can see, we broke it right here, okay? As soon as this tail went above that line, we broke that line. And then look what happened. Boom. We got that move up. Okay. So this is a bull flag, and it's a great way to figure out how to enter pullbacks in a bull trend. Pullbacks in a bull trend. And a pullback in a trend is one of the highest probabilities. In fact, it is the highest probability setup in all of trading.
And look, we go from the 50s right up there to the 135s. We need a trap. Basically, we need momentum. We need a run of stops. We need people to jump in, create liquidity. These shorts that shorted there are now getting shorted. They're getting, stopped out. They're chasing the price action. They're having to.
And that explains why, right? It's one thing to know what setup to trade, right? We just explained that. But you know why that happens? That happens because there were bears who were convicted, that were confident that this price was going down. And as soon as we got this candle and then this candle, those bears were forced to panic out of their positions. So now what you have is you have bears who were selling now buying, because that's how you buy back your shorts, which causes the price to go up. And then you have bulls taking advantage of those trapped bears buying as well. So everyone's buying. And when everyone's buying, you get an uptrend.
Cover. The bulls are starting to jump back in for this, overall bullish breakout there.
All right, so we've got all of our rules mapped out. We've got the last one here, which is those traps. You notice that you have these fake breakdowns and fake breakouts that trigger market reversals. That's just what we pointed out. This looks like it's breaking out because it's a big, strong bear bar closing on its low. But instead of breaking out to the downside, we faked you out. Sorry, we faked you out. And now we're going the opposite direction. Then those stops getting hit leads to momentum moving the market upward. So if there were bulls down here, right, then they're going to participate in the same way that the bears are going to participate once we get up here. And that's why you get that up move, okay? It is crucial to recognize when traders are getting squeezed. What does squeezed means? Trapped. The mantra is find the trap before you get trapped.
So find the trap. If you can see the trap before you enter a trade, look for a liquidity run. Look for something to happen before you enter a trade. We're looking for either the market to trick one side or the other, the bulls or the bears. I don't care who the market's tricking. I just want to be able to be like, hey, look at that. That was the trap. I saw the trap. I see the trap. Ha 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 ha. I'm getting in now that I see the trap.
But he doesn't explain how. So let me explain how. How do you avoid getting trapped yourself? You wait for confirmation, okay? There's two things that you can do. One is waiting for the candle close. You should already be doing that. But the second one is waiting for confirmation. So one bear bar closing on its low, not enough. What I mean by confirmation is a second close, right? So if you waited for this bear bar to confirm, meaning a second consecutive bear bar, and then you didn't get it, now you just saved yourself from the trap. So that's how you avoid the traps, is waiting for confirmation and waiting for those candle closes.
Same idea here, right? The bulls get overconfident. We get the breakout up to the 60 level. And we kind of push around here and we pull right back. So I'm looking for basically like wicks. I want to see wicks, and kind of breaking through certain levels. This was like a little bit of a trap right here. We broke through the support for a second. We pushed right back up. We got denied. But as you see, we start to put in these kind of lower highs, and start pushing back up. So the more that we can identify kind of where those traps are, where those opportunities are. And what's interesting here is, look, this area from earlier, that 50 area, guess what? Turns into support. We push right back up. I think you really got to be looking for previous areas of resistance turning into support. And that's really going to be a strong indicator of a bullish or a bearish move. So if a previous area of support turns into resistance, well, that's not good for the bulls. If a previous area of resistance turns into support, it's not. That's good for the bulls. Good for the bulls. Good for the longs. So you're looking for areas where the market's trapped people, and then you're looking for that area either turn into support or resistance, because it's going to be a much stronger move. So like we talked about here, again, kind of trapping above this level here. We pull back, we put in that lower high, put in that higher low, and now we start pushing back up. And we're like, oh, these shorts that are short in here thinking we're going to move down. Well, now they're kind of stuck in here, and guess what? Whoop, we rip it on up there. So find the trap before you enter a trade. It'll make your life a lot easier, my friends. Find the trap. Don't be the trap. Well, be the trap.
Again, wait for those candle closes and that confirmation. That's how you avoid that, okay? I wish he gave some instructions on that, but that's why you got me here, right? Okay, now here's your Trades by Bren Take Action Challenge, because I know you're not just here to be entertained. You're here to actually apply what you learned. So I've got 2 challenges for you. So the first one is identify key structure using the 15-minute rule, just like we showed you in this video. Open the 15-minute chart and mark the 50% level of the latest strong candle and ask this question: is the price holding above or below this level? If it's holding above, the trend is bullish, so look for a long entry. And if it's holding below, then the trend is bearish, so look for a short entry. Then screen record your results and share them with our community on this channel. You get it? Got it? Good. Challenge number 2. Use trend lines and traps to confirm your trade. Just like I showed you in this video, Patrick showed you, and I offered you some additional ways of doing that. Draw the trend line, connect the most recent swing lows for longs or swing highs for shorts. Look for that trap, which would be a fake breakout or breakdown that quickly reverses. And your entry is going to be taking a trade when the price bounces off that structure or traps traders in the wrong direction. Then screen record your results. And I showed you how to use those bull flags in order to be able to identify those, okay? So use those for Take Action Challenge number 2. And what I want you to do is not test this on a live account, obviously. I think you already know this, but you're not going to do any testing ever on a live account, because your simulator, your paper trading account, is for testing. Then once you test and prove something, then you move it to the live market. If you liked this video and you're curious about my strategy, I'd be happy to share my 3 favorite trades with you. And what I will do is I will offer you a free downloadable PDF where I'll share those 3 favorite trades, and I will share with you the 3 patterns that I look for, my 3 favorite setups, in order for me to identify those 3 trades. And then for each of them, I will share with you how I limit my risk, exactly how I set my stop loss, and then how I set my profit target so I can get out before it's too late. To get that, all you need to do is go to tradesbybren.com or hit the link in the description. And if you're curious about how I trade, this is the software that I use, and I use this with the prop firm. So I'm trading, and you can get started trading with less than $100 with prop firm trading. And you take a prop firm and you plug it into TradingView, and you're trading. You could literally start today. If you want a link to check out those tools that I use and recommend, hit the link in the description. Hit that like button if you like the video, subscribe if you want more, and I'll see you in the next one. Thanks for watching.